Good morning, estimated members of the Board of Directors. Thank you for convening today. I am Uzma and I serve as the Director of Corporate Liquidity and Risk. Before we dive into the core financial analysis, it is my privilege to introduce our executive financial team who collaborated on this comprehensive assessment. As their profile appear on your screens, allow me to present the members of our advisory team. Amira, Head of Operational Strategy and Efficiency, Auni, Chief Capital and Solvency Strategist, Alia, Director of Profitability and Market Intelligence, and lastly, Daniel, Chief Strategic Advisor. Together, we have conducted a rigorous cross-sectional analysis to evaluate our strategic standing against key industries benchmark. Moving into our baseline context, this evaluation focuses on a direct cross-sectional comparison between two prominent industry peers in the food and beverages sector, Hapseng Industries Berhad and Huatai Industries Berhad. While Hapseng is established as a cash-rich market leader with robust profitability, Huatai represents a more vulnerable competitor operating on narrower margins. Despite their differing operational scale and strategies, a comparison is highly justified. To ensure absolute analytical integrity and a strictly aligned baseline timeline, our financial analysis is fully anchored on the audited annual reports for the financial year ended 31st December 2025 for both entities. Let us now direct our attention to the liquidity performance, which serves as our corporate breathing room. The vital buffer required to meet short-term obligations without triggering immediate cash flow crisis. Looking at the current ratio, Hapseng demonstrates an exceptional short-term financial cushion at 2.11 times, indicating they have more than enough liquid buffer to cover immediate debt comfortably. In stark contrast, Huatai is operating at a tighter 1.06 times. The risk becomes significantly clearer when we isolate inventory by examining the quick ratio. Hapseng maintained a highly resilient posture at 1.64 times. However, Huatai falls below the safe threshold to a concerning 0.83 times. This signals that Huatai faces a high cash flow risk and relies dangerously on rapid inventory liquidation just to meet its urgent immediate obligations. In summary, while Hapseng holds a commanding risk-averse liquidity position, Huatai is navigating on thin ice. However, liquid cash is only one part of the story. How efficiently these assets are being mobilized is equally critical. Now, I will pass the floor to our efficiency specialist to evaluate our operational velocity and asset turnover. Thank you.
Thank you, Uzma. Estimate member of the board, I am Amira, your operational strategy and efficiency. In this section, I will present the efficiency ratio, which measure how efficiently each company use its resource to generate sales. Firstly, the inventory turnover ratio. Hapseng record 8.19 times compared to 5.41 times for Huatai. It shows that Hapseng managed its inventory more efficiently, allowing product to move faster while reducing inventory holding costs.
Next is
Total asset turnover ratio. Hapseng record 1.58 times while Huatai record 1.02 times. This indicates that Hapseng used its asset more efficiently to generate sales, reflecting stronger operational performance. And lastly, Hapseng record a receivable turnover ratio of 9.51 times compared to Huatai 2.62 times. This shows that Hapseng collect payment from customer more faster, resulting in healthier cash flow and lower credit risk. And now, I will pass to Auni to continue solvency analysis.
Alright. Thank you, Amira, the esteemed members of the board. My name is Auni Shakirin and I am your Chief Capital and Solvency Strategist. So, while liquidity measures our short-term breathing room, solvency dictates our long-term structural survival. Today, I will break down the capital architectures of our subjects, evaluating their structural leverage risk and their operational vulnerability to macroeconomic shocks. Let us evaluate the core metrics. First, Hapseng operates an exceptionally conservative, risk-averse capital model. Their debt ratio sits at 33.46% and their debt-to-equity ratio is a comfortable 50.29%. This confirms their operations are heavily equity-funded, yielding zero structural debt strain. Second, look at Huatai. They are aggressively leveraged. Their debt ratio sits at 71.54% and their debt-to-equity ratio reaches an alarming 251.61%. This indicates severe structural risk. Huatai is deeply dependent on external creditors just to keep its daily operations afloat. This exposure becomes dangerous when looking at the interest coverage ratio. Hub Seng possesses an astronomical cushion of 2,449 times, making them entirely immune to interest rate spikes and securing continuous dividend resilience. Conversely, Huatai has a rather thin margin safety at just 1.74 times. If we experience negative operating leverage, Huatai's thin 1.47% net profit margin faces a severe profit shock. A minor interest rate spike could completely wipe out their earnings, forcing management to freeze all dividends to fund their 1.88 million ringgit Malaysia debt obligations. In summary, while Hub Seng is structurally bulletproof, Huatai is highly vulnerable to insolvency. With all solvency structures established, we must look at how these dynamics impact the bottom line. Next, our profitability specialist, Alia, will analyze how effectively these operations convert into real net returns. Thank you.
Thank you, Auni, for the clear explanation on debt and long-term risk. Good day to the members of the Board of Directors. I am Alia, your Director of Profitability and Markets Intelligence. Now that we have seen how both companies manage their loans, let us move to the most important part of our analysis, how much profit they actually make and how the market views their financial valuation. Let us start with our slide on profitability performance. When we look at profit, there is very interesting contrast here. If you look at the gross profit margin, Huatai is actually leading at 31.57% compared to Hub Seng at 29.77%. This means Huatai is doing a great job at production and managing their cost of goods sold. But when we look down at the operating profit margin, Huatai's number dropped heavily to only 3.06%, while Hub Seng stay very strong at 16.32%. This big drop is a clear sign of weak expense control. It proves that Huatai's daily operating overheads and administrative costs are too high and are eating up their revenue. Because of this, Hub Seng shows superior cost management. They control their expenses well and finish with a strong net profit margin of 12.62%, while Huatai is left with a weak bottom line of only 1.47%. For the board, the final goal is to see the returns on your investment. Thanks to their good cost control, Hub Seng gives outstanding returns to investors with a returns on asset of 20.01% and a huge return on equity of 30.08%. Sadly, Huatai underperformed heavily, giving a return on asset of 1.51% and return on equity of 5.31%. Now, let us look at the next slide to see how the stock market reacts to this financial result and the market performance. The huge difference in profit definitely affects how investors view this company. Looking at earnings per share, Hub Seng creates higher value at 6.23 cents per share, which is much better than Huatai's, which is 2.09 cents. This proves Hub Seng can pass real, concrete value back to its stock buyer. The most critical benchmark here is the price to earning ratio. Hub Seng offers an attractive market valuation at a PE multiplier of 15.97 times. On the flip side, Huatai trades at a more expensive premium of 20.81 times earning. For the board, this is a clear warning sign. Buying Huatai means paying a higher price for a company that makes less profit. Hub Seng is clearly the safer and more realistic investment option. In short, while Huatai is good at generating top-line profit, Hub Seng wins completely in controlling costs, using assets and giving real value to the market. Now that we have covered all the financial ratio, we need to see how this number connect to real business strategy. I will now hand over the floor to Auni and Amira for our combined SWOT analysis. Thank you.
Thank you, Alia. So now I will present SWOT analysis of Hub Seng Industry Berhad, which evaluate the company's strength, weakness, opportunity, and threat. Starting with the strength, Hub Seng maintain a strong financial foundation supported by healthy liquidity, efficient operation, strong profitability, and a conservative capital structure. This strength provide greater financial flexibility and support the company long-term growth. However, despite its strong financial performance, Hub Seng experienced a decline in net profit due to rising raw material price and higher operating costs. The company also remained highly dependent on its bespoke product and domestic market, making its revenue more concentrated. In terms of opportunities, Hub Seng is well positioned to benefit from government consumption initiative, expansion into ASEAN market, and the growing demand for healthier food products. Its continued investment in sustainability initiative also strengthen the company's future growth potential. On the trade side, the company continued to face rising raw material costs, increasing competition from imported bespoke products, and changing consumer preference toward healthier food choices. These external challenges may affect future profitability if they are not managed effectively. Overall, Hub Seng's strength outweighs its weakness, placing the company in a favorable strategic position for sustainable long-term growth.
Thank you, Amira. Next, I will present the SWOT analysis for Huatai Industries Berhad, highlighting the company's internal and external strategic factors. Starting with its strengths, Huatai demonstrates a high gross profit margin alongside efficient factory cost control. These factors showcase the company's strong foundational ability to generate revenue relative to its direct production costs. However, Huatai faces critical weaknesses including a high solvency risk and a fragile interest safety net due to its heavy debt burden. Additionally, severe inefficiencies in cash collection continue to heavily tie up its operational liquidity. In terms of opportunities, Huatai can pursue capital recapitalization, such as rights issuance, to effectively wipe out its existing debt. There is also potential to expand their healthy product lines to attract ESG-focused investors. On the threat side, macro challenges like inflation risk completely wiping out Huatai's thin margins. Furthermore, a potential credit squeeze from suppliers and banks could drastically restrict its access to crucial working capital. Overall, Huatai's financial risk weigh heavily against its operational strengths. With that, I would now like to hand the floor over to Daniel to present our final investment recommendation. Thank you.
Thank you, Awni Shakirin. My name is Muhammad Daniel Hazim. I'm the Chief Strategy Advisor. Let me begin with Hub Seng competitive advantage over Huatai. The strongest indicator is operational efficiency, which is Hub Seng recorded a return on asset of 20%, significantly higher than Huatai's, which is 1.51%. This means Hub Seng generates substantially more profit from every ringgit invested in the asset. This performance is supported by stronger asset utilizations. Hub Seng achieved a total asset turnover ratio of 1.58 times compared to 1.02 times for Huatai, indicating that the company is more effective in converting asset into revenue. In addition, its inventory turnover ratio of 8.19 times reflect better inventory management and faster sales conversions. Although Huatai reported a slightly higher gross profit margin, Hub Seng clearly outperformed in both operating profit margin and net profit margin. This demonstrates a superior cost control and also stronger profitability. Furthermore, Hub Seng earning per share of 6.23 cent is nearly 3 times higher than Huatai, which is 2.09 cent, indicating greater value creation for shareholder. Overall, Hub Seng's ability to generate higher profit, utilize asset efficiently and deliver stronger shareholder returns provide a clear competitive edge. Moving next is the growth outlook. Members of the board, looking at the future growth potential, Hub Seng is in a much stronger position financially. The company maintains a strong liquidity with a current ratio of 2.11 and a quick ratio of 1.64. This indicates that Hub Seng can comfortably meet its short-term obligation while retaining sufficient resources to fund future growth initiatives. In terms of financial stability, Hub Seng's debt ratio stands at only 33.46% compared to Huatai, which is 71.54%. More importantly, Hub Seng interest coverage ratio exceeds 2,000 times, demonstrating an exceptional ability to meet debt obligation with minimal financial risk. This strong financial position provides management with greater flexibility to invest in expansion, innovation, and also strategic opportunity without relying heavily on external financing. By contrast, Huatai, which is higher debt level and weaker liquidity, significantly limits its growth capacity and increased financial risk. Therefore, Hub Seng possesses a financial strength and flexibility necessary to support sustainability long-term growth. For the members of the board, based on our analysis, we recommended that the board buy Hub Seng's Industry Berhad and avoid investing in Huatai Industry Berhad. This recommendation is supported by three key factors, which is the first one, Hub Seng demonstrates a superior operational efficiency and profitability, generating significant stronger returns from its asset and operations. Secondly, the company maintains a healthier financial positions, characterized by strong liquidity, low leverage, and also minimal financial risk. And thirdly, Hub Seng possesses a greater financial flexibility to support future expenses and create a long-term shareholder value. While Huatai remains established player within the industry, its high dependence on debt, weaker profitability, and also limited liquidity reduce its attractiveness as investment opportunity. In conclusion, Hub Seng represents the stronger investment choice due to its financial stability, operational excellence, and also sustained a growth potential. Before we conclude our presentations, the board of directors raised a critical scenario question for us. What if The company's sales dropped by 10% due to the change in the consumer behavior. What will be the impact on efficiency, margins, and dividends? To address the board's concern, our committee members will review the impact one by one directly. Thank you.
Based on our analysis, if total sales decreased by 10% in 2026, Hubseng's asset turnover ratio and net profit margin will both decline. This means the company will use its asset less efficiently and earn lower profit from its sales. As a result, there will be less earning available for dividend payment. Although Hubseng may reduce its dividend payout to retain more earnings, it's still a better financial position than Huatai, which is expected to face greater pressure due to its weaker liquidity and higher financial risk.
So, for this scenario, we can assume that the company credit policy and average trade receivable remain unchanged. When sales is decreased, the company will collect less money from customer. As a result, the receivable turnover ratio will decrease from 9.51 times to 8.56 times, which means the company needs 43 days instead of 38 days to collect payment. Next, the net profit margin will also decrease because company earn less money but still need to pay fixed costs such as salary and depreciation. Lastly, even though profit become lower, Hubseng is still expected to pay dividend because the company has strong liquidity and low debt. However, Huatai may find it harder to pay dividend because it has lower profit and higher debt. Okay, that's all from me. Thank you.
From my perspective, a 10% sales drop triggers a severe financial chain reaction. First, it damages efficiency by slowing down inventory turnover and driving up holding costs. Second, it directly squeezes the net profit margin because fixed operating expenses remain unchanged. Consequently, the ultimate blow lands on dividends. A cash-rich company like Hubseng can easily buffer this shock to maintain payouts, whereas a debt-burdened company like Huatai must suspend dividends to prioritize debt servicing and avoid insolvency.
Thank you, Ami. Moving on to the sensitivity analysis, a hypothetical 10% drop in sale revealed a stark contrast in financial resilience between both companies. For Hubseng, operational stability remains highly secure, although total asset turnover compresses to 1.42 times and operating leverage impacts net profit. Their strong baseline profit margin of 12.62% provide a solid safety cushion. The ripple effect on dividend is merely moderate, allowing payouts to continue at a slightly lower growth rate. Conversely, Huatai faces a critical outlook, starting with a weak profit margin of just 1.47%. A further 10% revenue decline completely erodes their financial capacity, eliminating any chance of resuming dividend distribution for the foreseeable future.
Thank you, Alia Yusra. For the questions, if the total sales were to decline by 10% in 2026, both companies will experience pressure on profitability. However, the impact would be significantly different. For Hubseng, the decline would reduce revenue and slightly compress its net profit margins. Nevertheless, due to its strong operating margins, low debt levels and also healthy liquidity positions, the company should remain profitable and continue generating sufficient cash flow to sustain a dividend payment, although dividend growth may moderate. For Huatai, the impact would be more severe given its already thin net profit margin of 1.47% and high financial leverage, or a 10% reduction in sales could substantially reduce earning or potentially push profit close to break even. This would place pressure on cash flow and also significantly limit its ability to maintain dividend distribution. From a strategic risk perspective, Hubseng demonstrates a greater resilience under a revenue stress scenario, further supporting our investment recommendations. In conclusion, Mr. Chairman and also member of the board, to conclude, our analysis demonstrates that Hubseng's industry Berhad is the stronger company across the key dimensions that matter most to investor: operational efficiency, profitability, financial stability, and also growth potential. Hubseng consistently generates higher returns from its asset, maintains stronger liquidity, operates with significantly lower financial risk, and deliver greater value to shareholders through superior earnings performance. Furthermore, our stress test analysis show that Hubseng is better positioned to withstand adverse market conditions while preserving its ability to generate profit and also support dividend payment. Although Huatai remains an established industry participant, its higher debt burden, weaker profitability, and also limited financial flexibility constrain its future growth prospect. Therefore, based on both current financial performance and long-term strategic outlook, I confidently recommended and buy position on Seng Industry Berhad and avoid position on Huatai Industry Berhad. Thank you everyone.